Hi, everyone. This is Lynn. There is a major opportunity in the market right now, and almost no one is talking about it the right way. If you care about long term investing, hit subscribe because what we're about to break down is one of those rare setups where fundamentals and price are clearly out of sync. And those moments don't last long. There's a company that is already one of the most profitable tech giants in the world. It just delivered a near flawless earnings report. Revenue beat expectations. Growth is strong. The business model is still incredibly powerful, and yet the stock has dropped sharply over the past few months. That company is Meta. In the US stock market, opportunities created by fear tend to repeat. The script is playing out again. And when the market finally understands what's really happening, the window to act is usually very short because large capital never waits for full consensus. They move when uncertainty is highest, when fear is strongest, and when prices are cheapest. Let's start with a simple but critical point. Most people look at a stock and immediately look at the price. If it's going up, they assume the company is great. If it's going down, they assume something is wrong. But serious investors think differently. In the short term, price matters. In the long term, the business is everything. And Meta right now is a perfect example of this disconnect because the fundamentals are not weak. They are extremely strong. In 2025, Meta generated over $200.9 billion in revenue. That's 22% year over year growth. Fourth quarter revenue alone was nearly $59.9 billion, up 24%. This is not just good, this is outperforming expectations. And more importantly, this growth is not coming from hype. It's not just an AI story, it's coming from a real business engine. Advertising, user engagement, platform efficiency. These are cash generating systems, and they are scaling. Meta's ecosystem now has around 3.58 billion daily active users. Think about that. That's nearly half the world's population interacting within its platforms. As long as users stay, scroll, and engage, the monetization engine remains intact. And right now, that engine is still running extremely well. So if the business is strong, why is the stock down? The answer is simple: AI spending. Meta's capital expenditure in 2025 exceeded $72 billion. And for 2026, guidance is between $115 and $135 billion. That number makes the market uncomfortable because it raises a very natural question. Are they entering a phase of aggressive spending with uncertain returns? Short term, the answer is yes. Free cash flow will be under pressure, margins may compress, that's real. But here's the key distinction: Meta is not pouring money into a broken business. It is investing to upgrade an already highly profitable machine. That difference is everything. When a company with weak fundamentals spends aggressively, that's a gamble. When a company with strong fundamentals invests to improve efficiency, that's optimization. Meta already has scale. It already has users. It already has a highly effective ad system. Now it is using AI to improve targeting, increase engagement, and enhance conversion. If those inputs improve, the output is obvious: more revenue, higher efficiency, stronger margins over time. So, what the market sees today is rising cost. But what long term investors should see is future earning power. Let's talk about Meta's moat, because this is where things get really interesting. Meta is not just a tech company, it's a data and attention platform at global scale. 3.58 billion users generating behavioral data every single day. That creates a network effect that is almost impossible to replicate. And the monetization model is incredibly efficient. Users create content for free. That content attracts more users. Meta inserts targeted ads into that flow, and the marginal cost of those ads is close to zero. This is essentially a high efficiency cash machine. If you want to measure that efficiency, look at return on invested capital. For years, Meta's ROIC has consistently exceeded its cost of capital. Even during the downturn in 2022 and early 2023, it remained strong. At peak, it reached nearly 48%. That tells you something very simple. This is a business that converts capital into profit extremely effectively. Now we get to the key question: is the stock cheap? Right now, Meta is trading around $654. The market expects 2026 EPS to be about $30.24. That puts the forward PE at roughly 21 times. For 2027, it drops closer to 18 times. Meanwhile, the average Wall Street price target is around $862. That's more than 30% upside from current levels. So the market is pricing Meta as if its future is uncertain. But the underlying business does not reflect that level of risk. Let's push this further using a simplified valuation framework. Assume a 15% annual return target. That implies your capital doubles roughly every 5 years. Assume long term EPS growth around 20%, and a reasonable valuation multiple of 30 times earnings, given its moat and scale. Under those assumptions, fair value today comes out around $760. And over a longer horizon, the upside becomes much more significant. This is not about short term price movement, this is about long term compounding. So, what's the real situation? The market is focusing on short term cash flow pressure, but ignoring long term earnings expansion. This creates a time mismatch. And that mismatch is where opportunities come from. If two things happen over the next couple of years, the repricing could be significant. First, AI investment starts translating into measurable revenue gains. Second, the temporary cash flow pressure fades. Once the market sees both, sentiment shifts. And when sentiment shifts, the price usually moves fast. Now, let's be clear, this is not a zero risk investment. There are real risks. If AI spending fails to deliver expected returns, valuation will compress. Regulatory pressure is always present for a company of this size, and competition for user attention never disappears. Even strong platforms can be challenged. So the thesis is not that Meta is perfect, it's that the risks are real, but not large enough to break the long term story. So here's how I think about this. This is a company with a proven business model, a massive user base, a strong moat, and a clear path to improving its core engine. But it's currently being priced based on short term fear. That combination is rare. And that's exactly where opportunities tend to exist. I'm Lynn. If you want to see through market noise and focus on what actually matters, make sure you subscribe, and I'll see you in the next one.